Welcome everyone, my name is Angelo. As Warren Buffett's right-hand man, billionaire investor Charlie Munger correctly pointed out already back in 1994, reaching the first $100,000 or euros in our case is the hardest, but it gets easier afterwards. Today we'll discuss some of the reasons why that is the case, especially when starting from zero, and why the next 100,000 euros tend to come a lot faster. Let's dive right in. The thing is, we're used to thinking in linear terms. We just assume that if we put aside 1,000 euros per month, we're gonna have a total of 120,000 euros after 10 years and so on. But we completely forget the power of compound interest when we invest this money, which can lead to exponential growth. I use a growth rate of 7% to show you what I mean, which is the average yearly return of a well-diversified stock market ETF covering the FTSE World or MSCI World Index based on historical data. Using the rule of 72, you can calculate how long it takes for your money to double using different rates of return or interest. At 7%, it should take around 10 years. At 10%, only 7 years. While at an annual return rate of 4%, it should take you about 18 years to double your investment. For our example, we'll be using 7% per year. Just keep in mind, this is a long-term average global stock market indexes have produced so far. There are obviously fluctuations not only to the upside, but also the downside on a yearly basis when you're index investing via ETFs. So if we invest 10,000 euros and never add a single extra euro, in our simplified example at 7%, it would take us around 34 years to reach 100,000 euros, while the next 100,000 euros would only take us about 10 years, the next only 6.5 years, then only 4 years, and so on. This is because our returns are compounding based off a larger and larger investment amount. Before we take a look at what would really have happened in the stock market based on actual returns, don't forget to gently tap the like button if you're enjoying the video so far and to subscribe if you haven't yet. Also, if you'd like to support me, you can find links to the best low-cost brokers in Europe for stocks and ETFs in the description below. Alright, looking at the MSCI World using the backtesting tool on Curvo, we're only able to go back until December 1978, so about 44 years. Still, let's see what would have happened since then to an initial 10,000 euro investment without adding a single extra euro and compare that to our theoretical example. Due to above average returns at the start of this period, from 1979 to 1996, it actually only took about 17 years to reach the first 100,000 euros. The second 100k already arrived about 3 years later, while the next 100k took a lot longer, 15 years, due to the dot-com bubble and the financial crisis. That being said, it then grew by an additional 100,000 euros 2 years and 4 months later. The next 100k took another 2.5 years, and just 1.5 years later we were sitting at 600k already. That's about 41 years after only investing 10,000 euros at the start and never adding a single extra euro afterwards. While in our theoretical example with a 7% return per year, we should quote-unquote only be sitting on 175,000 euros after that same period. How is that possible? Well, we can see that the MSCI World had a compound annual growth rate of 10.10% since December 1978, which is 3.1% more than the 7% average we're calculating with. Meanwhile, if we start our comparison 10 years later in December 1988, it would have taken us until March 2021, so a total of about 32 years for our initial 10,000 euro investment to grow to 100,000 euros. That's because the compound annual growth rate of 7.41% over this period was much closer to the 7% we're calculating with long term. This also shows you how much of a difference a different sequence of returns and a higher annual growth rate can make. Now in example number 2, let's assume we start at 0 and invest 1,000 euros per month. Once again, using 7% as an average, we should reach the first 100,000 euros after 6.5 years, 200,000 euros 4.5 years later, 300,000 euros 3.5 years after that, and cross 500k between year 19 and 20. Not only that, what's interesting to realize is that due to how compounding works, at 284,000 euros in year 14, we would actually already be halfway towards €1 million. Now let's compare these numbers to what really happened in the stock market to see what the differences were over the past 20 years, starting in September 2003. Here we're once again doing a backtest on Curvo, this time using a FTSE World ETF. My wife and I buy the same ETF in its accumulating version on a monthly basis, since it enables us to easily invest into over 3,600 stocks from all across the world, including emerging markets like India, which currently make up around 10% of the index. Beginning at 0 and adding 1,000 euros per month, due to the financial crisis in 2008, it would have taken us until November 2010 to reach 100,000 euros. That's a bit over 7 years, slightly longer than the 6.5 years we calculated in our theoretical example with a fixed annual growth rate of 7%. However, we then reached the next 100k milestone just 3.5 years later by July 2014, and the next 100k took less than 2.5 years. The following 100k took even less, and lastly, less than 2 years later, in February 2021, we would already have been sitting at over 500,000 euros. And yes, I'm aware that apart from the great financial crisis in 2008 and the COVID crash in 2020, the stock market performed very well over the past 20 years. If you happen to have your first 100,000 euros invested right before a major market crash, it's also possible that reaching the 200k milestone may take longer than the first. Still, I think the two examples I gave you are a good way to see the power of compound interest in action and why the first 100k tend to take the longest in comparison. Of course, there are other reasons as well. Generally speaking, the beginning is more difficult since your returns are based off a smaller investment amount, so they make less of a difference overall. For example, a 7% return on 1000 euros worth of investments is only 70 euro per year, an amount that's easily earned by working extra hours. Additionally, chances are that if you're just starting out, you probably also have a lower savings rate. Perhaps you're still at the beginning of your career. At this stage, it's best to focus on ways to increase your earning potential over time, instead of trying to inch out an extra percent in returns on a small portfolio amount, something that's very difficult to do anyway over the long run compared to just buying low-cost passive ETFs. For example, you could try learning new skills, ask for a raise, or consider switching to a better paid position if you get the chance. That way, you should be able to dramatically increase your savings rate over time, especially if you manage to keep your expenses under control, which slowly gets you closer to the first 100,000 euros and then gets the snowball rolling. And while, as I said in the beginning, a 7% return on 1,000 euros worth of investments is only 70 euros, the same return on 50,000 euros is already 3,500, and on 100,000 euros worth of investments, we're already talking about an extra 7,000 euros per year. For my wife and I, a 7% return on our combined investment portfolio of 325,000 euros translates into 22,750 euros extra each year, an amount that will be quite difficult for us to earn in addition to what we're already making from our work. Now, once you reach your first 100,000 euros as your first goal, you're also likely to feel a lot more relaxed about your finances in general. That's because at this stage you accumulate a large enough amount that you don't need to worry about losing your job, as you'll be able to cover your expenses for a long time. Okay, unless maybe you live in a mansion and have 8 kids, but I'm assuming that's not the case for most of you. What this means is that you're also able to take on certain risks compared to before. Perhaps you see a chance to earn more long term if you started your own business. Now that you accumulated 100k, you know that you're covered for a long time either way, and if it doesn't work out, you could always go back to employment later on. Meanwhile, as an employee, you might feel more confident when asking for a raise. That's because you now have more leverage on your side when negotiating your salary, since you're able to walk away from your current job anytime in search for another one that more closely meets your financial requirements. From an investment perspective, once your portfolio reaches a sizable amount like 100,000 euros, you're able to take on more risk with a small percentage of that if you see an opportunity. For example, single stocks you strongly believe could outperform the market. Just keep in mind that's very hard to do over the long run successfully, which is why I don't even try and just stick to passive low-cost ETFs, or even highly speculative bets like crypto or other alternative investments. If these additions go well, then great, they could give your portfolio a little boost in returns, while if they fail, then their downside will be limited to a small percentage of your overall portfolio. In the finance realm, this is also known as a core satellite strategy, where you have your large core component, for example a well-diversified low-cost ETF you plan to hold on to for decades, as a primary driver of long-term growth, and one or several smaller satellites, which could be things like P2P lending, crypto, or other alternative investments. Just to clarify, I'm not saying that you need to add additional investments, or even that these will improve or smooth out your returns, since that's impossible to predict. I just wanted to point out that once your portfolio grows to 6 figures in size, you simply have more options, some of which could be worth considering. Perhaps the investment journey my wife and I have been through over the past 7 years, since we started working on our early retirement goal, could help you better understand some of my reasonings from this video so far. While we didn't start at zero, we already had about 40,000 euros in savings in the beginning of 2017. It took us about 2.5 years to add 60,000 euros to reach our first 100,000 euro milestone in mid-2019. And then, just 4 years later, by mid-2023, our portfolio already crossed a total of 300,000 euros. How is that possible? Well, there were a few reasons for this. First, throughout this period, both of us were earning more and more year after year from our jobs, while our expenses remained at the same very low level compared to what other people spend, which enabled us to save and invest over 70% of our monthly income. You can find out more in this video if you're interested. Second, our ETF portfolio, which is currently worth over 242,100 euros, grew by over 41,800 euros in value, with an internal rate of return of 7.9% 3.94% per year and average yearly returns of 9.36% per year. Third, and this has to be said, I won't deny that some luck was involved as well when it comes to some speculative investments I made back in 2017 into the two largest crypto assets, Bitcoin and Ethereum. In fact, I was definitely over-invested compared to my overall portfolio size at the time, something I wouldn't do again today, especially not now that I'm a father of a beautiful 1-year-old girl. Well, I was able to realize a nice chunk in profits from these during the bull run in 2021, which helped our portfolio grow a bit faster than it would have otherwise. We then reinvested this money into ETFs, the foundation of our long-term investment strategy. Please keep in mind that this could very well have gone differently, so I'm not advocating that you try doing the same. I just wanted to be open and transparent about the fact that luck can also be a factor to a certain extent when it comes to investing. So, in summary, it's worth it to start working on your financial goals as early as possible and to get used to saving and investing regularly, no matter how small the amount is at the beginning. You'll gain valuable experience and build a habit that's likely to pay massive dividends over the long run, both figuratively and literally. And over time, perhaps as you're able to increase your income and savings rate and you reach your first 100,000 euros, investing becomes easier and more rewarding as you get the compound interest snowball rolling. It has certainly felt like that for my wife and I, and as a result, we're getting closer and closer to our goal of being able to retire early in a few years if we want to. But now I want to hear from you guys. Are you currently working on reaching your first 100,000 euros? Or if you're beyond that already, did the second 100k also come a lot faster in comparison? Let me know in the comments below. By the way, if you're looking for the best low-cost brokers in Europe for ETFs and you'd like to support me, feel free to use my links in the description below. Also, while you're down there, don't forget to gently tap the like button if you enjoyed the video and to subscribe if you haven't yet. And please keep in mind that none of what I mentioned today was of course meant as investment advice. I'm just openly sharing my own opinion and what I'm doing as an investor based on my own experience. Thank you guys so much for watching, have a wonderful day and until next time.